Have you ever pondered the inner workings of the share market? It's a bustling hub of financial activity, a place where buyers and sellers converge to trade shares. Now, you might be wondering, what exactly are shares? Well, they're basically slices of a company's ownership. Companies issue shares, turning to the public to raise capital for various reasons, funding expansion plans, paying off debt, or even fueling research and development. On the flip side, we have investors, individuals like you and me, or even big financial institutions who buy these shares. Why? The answer is simple: to potentially make a profit. As company profits grow, so does the value of your shares, leading to a higher selling price. This is the essence of the share market, a dynamic platform where money is put to work, where ownership is bought and sold, and where fortunes can be made. Now that we've skimmed the surface of what the share market is, let's delve a bit deeper, shall we? You might be wondering, how exactly does one buy or sell shares in this market? Well, the first step is to open a brokerage account. This can be done through a wide range of financial institutions, from traditional banks to online-only platforms. The brokerage acts as your middleman to the stock market, carrying out your orders to buy or sell shares. Once you have a brokerage account, you can start placing orders. There are two main types you should know about: market orders and limit orders. A market order is an instruction to buy or sell a stock immediately at the best available current price. A limit order, on the other hand, only executes the trade at a specific price you've set or better. So if you place a limit order to buy a stock at $20, for example, the order will only go through if the stock's price drops to $20 or below. Brokers play a crucial role in this process. They have access to trading networks and can execute trades on your behalf. In return, they charge a commission for their services. It's important to understand the fee structure of your brokerage, as these costs can impact your investment returns. But buying and selling shares is not just about placing orders. It's also about monitoring the market. The stock market is dynamic, with prices changing throughout the day based on supply and demand. By keeping a close eye on the market, you can make informed decisions about when to buy or sell. There's a lot to consider when trading shares, from understanding the mechanics of the market to analyzing the performance of individual stocks. It's a complex world, but with patience and willingness to learn, anyone can navigate it. With knowledge of how to buy and sell shares, you're already halfway to becoming a savvy market player. But what determines the price of these shares? Stay tuned to find out. Ever thought about what makes a share's price go up or down? Well, it's not magic or mere guesswork. Share prices are influenced by several factors, and understanding these can help you make more informed decisions. First off, we have company performance. If a company is doing well, making profits and growing, its share price typically rises. Conversely, poor performance usually leads to a drop in share price. Then there are economic indicators. Things like inflation rates, interest rates, and economic growth can all impact share prices. For instance, high rates of inflation or interest can discourage investment, leading to a drop in share prices. Lastly, let's talk about market sentiment. This is the general attitude of investors towards a particular company or the market as a whole. If investors are optimistic, they buy more shares and prices go up. If they're pessimistic, they sell off their shares, causing prices to fall. So, share prices can fluctuate based on a number of factors. But how can you make money in the share market? The ultimate question: how can you make a profit in the share market? Let's delve into the two primary ways investors make money in the share market: capital gains and dividends. Capital gains arise when you sell a share for more than you bought it. In essence, you're profiting from the increased value of that share. Think of it as buying a painting for $50, then selling it for $100. That $50 difference, that's your capital gain. On the other hand, dividends are a slice of a company's earnings paid out to shareholders. If a company you've invested in has had a profitable year, they may decide to distribute some of these earnings back to you as a dividend. It's like getting a thank you card with some cash inside for being a loyal investor. And there you have it, the basics of making money in the share market. Remember, knowledge is power, especially in the world of investing.